Hello and welcome back to the note. Well, we've heard from the ECB. We can confirm that QE bond purchases will indeed be starting on Monday. We have all the technical details, some of which were surprising. We also have a new forecast for the European economy from the eurozone, which is more positive than it was before, despite the extra positivity they are going through with what you would think was the crisis measure of QE. Now, up until recently, all that we really cared about in Europe concerned peripheral bond yields, the risk that the peripheral countries wouldn't be able to repay their debt. Well, the impact the ECB has had on confidence there is truly extraordinary. If we start by taking a look at Spain and Italy, the two biggest, most pivotal peripheral economies, this is their 10-year bond yields over the whole history of the eurozone, and you can see that the yields on both those countries' debt are now astonishingly low, certainly not suggesting that there's any risk of, to their credit, any risk of non-repayment. That's partly due to bearishness about the outlook for deflation, about sluggish economy, and obviously partly the effect of the ECB. But at least it makes it very easy indeed to avert any kind of a fiscal crisis. Now, if we take a look at Portugal and Greece, obviously the two countries that caused the greatest concern, Greece, despite the fact that we are still in a very elevated series of risks, that we only have a matter of months before we are likely to have another contretemps over renegotiating their debt, you can see that their bond yields are still very much lower than they were at the worst points of the crisis, plainly still very high in absolute terms. Portugal was the country that, as far as the market was concerned, seemed virtually certain to follow Greece in needing a haircut on its bonds at one point. Again, the effect of confidence there has been remarkable. Portuguese yields suggest there is really no risk of default there. Now, perhaps the most obvious and predictable consequence of all of this is that the euro has touched another 11-year low against the dollar. The market's bet is absolutely strong, total conviction now that we will see clear divergence between the monetary policy of the eurozone and the US this year. We have QE in Europe, we're going to get raising rates here in the States. Now, we have non-farm payrolls coming up, possibly the single most important data that the Fed will be looking at before deciding whether to make that call. Given how exposed people are to this notion of policy divergence, I would say that the risks are far greater that an undershoot, a poor employment number will lead to a sharp sell-off for the dollar, than that a really good number would push the dollar even higher. Plainly, with this positioning, the risks are asymmetrical. That's just talking about Friday's number. More broadly, we have a very intriguing situation where the market is betting that we are going to continue to get very loose monetary policy from the ECB, even though there is also a feeling that the eurozone economy is stronger than people thought. Meanwhile, there is a bet that in the US we're going to be getting raising interest rates, even though the US economy, if you exclude the labour market, US economic data is looking weaker than people had thought. It's going to be very interesting indeed to see how that is resolved.